Tesla reports its second quarter production and delivery numbers before the market opens tomorrow, and the gap between what Wall Street expects and what everyday investors expect is the widest anyone can remember heading into a Tesla print, as much as 60,000 cars apart. We've also got a big new interview with Tesla's head of vehicle engineering, including a tease about news coming next week. The first Optimus production line going in at Fremont, a striking collapse in General Motors electric car sales, Dan Ives leaving Wedbush, and more. This is the Tesla Brief, after the close on July 1st. Welcome to the show. A quick look at the stock. Tesla closed up 2.2% at $425.30, while the Nasdaq fell about 0.7%, and the S&P 500 slipped 0.2. So Tesla ran hard against a down market today. And this was Tesla specific, the stock extending its rally into tomorrow's delivery number rather than anything happening across the broader market. Let's start there, because that delivery number is the whole story right now. Tesla will tell us tomorrow morning how many cars it built and delivered in the second quarter. Normally, there's a range of guesses, and they cluster fairly close together. This quarter, they don't, and that's what makes this print unusual. Here's the spread. Wall Street's official number, the one Tesla itself publishes, compiled from a survey of 22 analysts, sits at 406,000 cars. But Troy Teslike, the independent tracker whose model most everyday Tesla investors follow, is all the way up at 466,000. Gary Black, who runs the Future Fund, is at 420,000, and says several other well-known voices land somewhere in the 420 to 430 range. So between the top of the retail range and the Wall Street number, there's a gap of about 60,000 cars. Gary Black called it the biggest divergence between retail analysts and the sell side that he can recall. For context, Tesla delivered about 384,000 cars in this same quarter a year ago. So even Wall Street's number would be modest growth, and the retail numbers would be a real acceleration. So why do the everyday trackers think the number is so much higher? The core of it is Europe. Weekly registration data there has been running about 20% ahead of last year, and the final week of the quarter came in 47% higher than the week before it. The theory behind the bump is that higher gasoline prices during the quarter pulled EV demand forward. People who were on the fence about going electric did the math at the pump and moved. Now, why does the size of this gap matter so much for the stock? Because the stock has already run up roughly 10% this past week, going into the earnings report. That tells you the market is leaning toward the higher, retail-style number being closer to right. And that cuts both ways. If the number comes in as a clean beat over Wall Street's 406,000, the reaction might actually be muted, because a good result is partly priced in already. But if the number lands closer to Wall Street's figure, or below it, the disappointment could be sharp, precisely because expectations got pulled up this week. So the thing to watch tomorrow isn't just the headline number, it's the size of the beat or miss against that 406,000, and a reaction in the first 10 minutes after it hits. There's a second layer to this that reaches past tomorrow. Gene Munster at Deepwater put out a call today that's less about this quarter and more about the direction of the whole car business. He put it this way: I expect an acceleration in growth from March to June, and more importantly, believe September will finish roughly flat year over year, compared to the street's expectation of down 9%. Read that carefully. He's not just predicting a good second quarter, he's predicting that the third quarter, the one ending in September, comes in roughly flat against last year, while Wall Street still expects it down 9%. If Munster turns out to be right, that's the moment that Tesla is a growth-challenged carmaker story starts to break. 2 quarters in a row where Wall Street was too pessimistic about the direction of the business. That's his call, to be clear, not ours. He's been a long-term Tesla bull for years, and his track record on these estimate calls is public. But it frames the real debate for tomorrow. If the second quarter beats, the argument immediately becomes whether it was a one-off pulled forward by gas prices or the start of a genuine turn. Munster is betting on the turn. And there's a data point out today that speaks directly to that debate. General Motors reported it sold 27,395 electric vehicles in the US in the second quarter, down 41% from the same quarter last year. And it wasn't a soft patch in one model. It was the flagships collapsing. The Equinox EV, GM's cheapest electric SUV, and the one meant to reach mass-market buyers, was down 62%. The Blazer EV was down 68%. Cadillac's Lyriq was down 16%. A couple of newer models grew, but from very small bases. Here's why that matters for Tesla. This is the exact same quarter for which the everyday trackers think Tesla did somewhere between 420,000 and 466,000 cars. If both things are true at once, GM's electric business falling off a cliff while Tesla's grew, then the popular electric vehicle demand is weak story is really a non-Tesla electric vehicle demand is weak story. That's a meaningful distinction. But it also raises a fair question for tomorrow morning. If Tesla did have upside in the quarter, how much of it came from buyers switching over from other brands, rather than brand new EV buyers entering the market? That's worth keeping in mind as the number lands. Away from the delivery print, the most substantive thing to come out today was a long on-camera interview with Lars Moravy, Tesla's head of vehicle engineering. He dropped a tease that's worth flagging. Twice in the interview, which is unusual for him, he said, quote, "In a week from Tuesday, there'll be some cool news about things happening on the campus of Texas, and I can't talk about it right now, but that's part of the scaling effort." A week from that Tuesday lines up to July 7th. He wouldn't say what it is, but he framed it explicitly as part of scaling. What makes the tease worth taking seriously is everything he said around it about the Cybercab, Tesla's purpose-built self-driving car. He said the Cybercab manufacturing line is now about 90% automated, and that Tesla has already built roughly 150 test units. And here's the striking part. The final assembly line uses only 20 to 25 workstations, against the 200 a normal Tesla final line uses. He said the team sketched that design on a whiteboard 5 years ago, and that inside the company people thought it was impossible. He expects Tesla will eventually build more Cybercabs than any other vehicle in its history. So July 7th is the date to circle, but the reason it matters is that it's sitting on top of specific, quantified progress on the vehicle Tesla is betting its next chapter on. There was a smaller detail in the same interview that says a lot about Tesla's manufacturing edge. And it's the kind of thing analysts don't model. New cars coming off the line in Texas now drive themselves, no one at the wheel. From the end of the assembly line over a track designed to shake the body and provoke any loose parts, and out to the logistics yard where they wait for shipping. On that drive, the microphones inside the car, the ones normally used for phone calls, listen for specific sounds. A particular door panel clip working loose has a known acoustic signature, and the car flags it so a human can fix it before the car ever reaches a customer. Moravy calls it, quote, full self-hearing. He also mentioned Tesla just placed third in J.D. Power's initial quality study, which measures problems owners report in the first 90 days, a study Tesla has historically ranked poorly in. The through line is that these unglamorous manufacturing advantages are exactly what underpin his other claim in the interview. He said Cybercab operating costs will, in his words, blow the minds of analysts because they don't grasp how efficient the whole system is. On Optimus, we got a real step forward today too. Elon posted a short video walking the first Optimus production line at the Fremont factory, on the floor space that used to build the Model S and Model X. Moravy filled in the details. The lines are modular by design, built and tested in Germany before they're shipped. And Tesla expects to be able to bring a new one online in about a week, once it lands at Fremont. He said there are roughly 40 of these sublines planned. One honest note of caution in there, though. Moravy also said Optimus is being built much more like a car than like a consumer electronics device. That's a useful reality check against the "we'll crank these out like phones" framing you sometimes hear from bulls. And it sets more grounded expectations for how quickly the cost per robot actually comes down. And the public reveal of the next-generation V3 robot design that Elon promised for late July or August still has no firm date. So the manufacturing footprint is getting real. Dozens of small modular lines rather than one giant one, but this is a build-it-like-a-car effort, not magic overnight scale. A notable one on the analyst side, CNBC reported this afternoon that Dan Ives, Wedbush's technology analyst and one of the most quoted names on Tesla for years, is leaving the firm for a new venture. The headline was blunt. Prolific tech analyst Dan Ives is exiting Wedbush for a new venture. What he's doing next hasn't been announced. Why it matters for Tesla investors? Ives has been one of the loudest bull voices on the stock, with a $500 price target he was defending as recently as this morning. If he lands somewhere that lets him keep publishing his own fund or firm, his Tesla views will probably still get airtime, just without a formal price target attached. If he lands somewhere that requires him to go quiet, then the loudest bull voice on the street goes silent for a while, and Wedbush's Tesla coverage passes to whoever replaces him. The thing to watch is that handoff. It'll decide whether the firm's rating and target hold, get revised, or get dropped. And one small signal worth a mention. The Coral Gables Fire Department in the Miami area posted that its people completed a training session this week with Tesla on emergency response for the Robotaxi platform, battery systems, emergency access points, and how to handle incidents involving driverless cars. On its own, it's minor. But Robotaxi is currently live only in Texas, Austin, Dallas, and Houston. And Elon has said the wider 5-city expansion is waiting on the next big software rewrite, which he's targeting for late this year. Fire departments don't train for services that aren't coming. So a Miami area department doing this quietly suggests a Florida launch is closer to real than hypothetical. The open question is whether Miami gets added before that software rewrite lands or waits for it. Which brings us to tomorrow, and it's a big morning. 2 things land within an hour of each other before the open. First, Tesla's second quarter delivery number. Wall Street at 406,000, Troy Teslike at 466,000, Gary Black at 420,000. Then, at 8:30 Eastern, the June jobs report, with economists looking for around 120,000 new jobs. The interaction between those two is what actually shapes the day. A hot jobs number would strengthen the case that the new Fed chair leans toward raising rates rather than cutting them. And higher for longer rates weigh more heavily on a stock like Tesla, whose value rests on profits that arrive years from now. A soft jobs number does the opposite. So Tesla's delivery beat or miss lands into whichever direction the jobs report pushes rates. And the combination is what moves the stock. The one question that ties it all together: does Tesla's number come in closer to Wall Street's 406,000 or to the retail range of 420 to 466,000? And does the jobs report harden or soften the case for a rate hike on top of it? One scheduling note: U.S. markets are closed Friday for Independence Day, so our next episode is Thursdays, the one that actually breaks down tomorrow's numbers. That's the Tesla brief for today. If it's been useful, please subscribe. Thanks for joining us, and we'll see you in the next episode.